How do you know when it is time for your business to convert from a limited liability corporation to an S corporation, or from an S corporation to a C corporation, or just plain old go straight to C corp or go straight to S corp? How do you know? One of the ways to make sure that you're putting your money back in your business is being in the right business entity type. Is it time for your business to step up and be an S Corp or a C Corp? I have 3 signs that it is time for your business to change to S Corporation. Okay. Sign number 1, pay yourself, and you can pay others. I say pay yourself at least 10%, 10% of your gross sales. So if your gross sales is $300,000, then pay yourself at least $30,000. Or my other piece of advice that I normally give to my business owners, I say, okay, add up your mortgage and your basic bills. And that is what you normally would pay for with your wage if you're a W-2, and make that your salary. Or if 10% is $200,000 for your business, I would recommend paying yourself $108,000, or $112,000, whatever the maximum amount is for employment tax for Social Security and Medicare. Those are my tips for how to pay yourself, and that's quick and dirty. Sign number 2, you are paying higher taxes via your personal tax return as a LLC, partnership, or sole proprietorship than you would pay as an S corporation. Okay. Everybody knows that an LLC, at least now you know, an LLC is taxed 2 times. Income tax, which is the income tax brackets, 12%, 22%, 25. And then it's taxed again for Social Security and Medicare, which is called employment tax. And that's a flat tax of 15.3%. So for example, if you are a business owner and you are being taxed and your LLC, you make $100,000, you're probably in the 20% tax bracket. You're paying $20,000 in income taxes plus another $15,000. That's like $35,000. And I'm exaggerating because it doesn't work like that. But basically, you're getting taxed at 35% versus being taxed at 20%. So therefore, your taxes as an LLC, a partnership or sole proprietorship, is causing you to pay an extra $15,000 or more in taxes. It's time for you to shift. All right. Number 3, you want to raise capital. Now, when I say that you want to raise capital, that means you're bringing in equity partners in your business. When you bring in an equity partner to an LLC that is not an S corporation, that is not a C corporation, that corporation dies. That means that no, your name doesn't change or anything, but in the eyes of the IRS and in the eyes of your state, your business has changed, because when you first started, it was you, Beth, and John. Now, if John leaves and now it's just you and Beth, that is a new partnership. Now, that does not happen when partners or owners or shareholders actually go in and out. That does not change or dissolve the partnership structure, because basically you're issuing shares, and the shares of a business are issued at the beginning of the business. So you have a business, you say it's 10,000 shares. You don't have to issue all of those shares. You can increase shares, decrease shares. It does not dissolve the business. Therefore, when you want to raise capital, you want to be able to let partners in and out of your business without having to dissolve your company every time. At that point, that's your trigger. I should be an S Corp or a C corporation. Those are some quick tips. That's your blessing for the new year. I'll come with some more tips for you guys, my free gifts that I'll be giving out. If you go to buildwealththroughbusiness.com and go ahead and register, I'm going to be issuing a free accounting system to you guys. Book a consultation. The initial consultation is free, but we're going to be offering free books to our clients this year. And I love to work with you guys. And I hope this tip blessed you. And I'll see you guys soon. Don't forget to move your profit in the right direction. And that's up in 2021. I love you guys. Bye.